Dialog bersama dengan Vishrut Rana, ekonomis Asia Pasifik S&P Global Ratings. Vishrut, global markets expectations are changing all the time. Last time, Vanguard projecting the Fed won't cut their rate until the end of 2024 based on U.S. economy resiliency. What is your perspective?
Yeah, that is, I think, the key economic question globally right now. How many times will the Fed cut interest rates and where will we be at the end of the year? There's a number of factors that I think the Fed is thinking about. One is that inflation in the first 2 months of the year in the US has been quite high. It has been above 3%, which is higher than the Fed's target range. And I think that gives them some pause in terms of the speed of the interest rate cuts in the US that we can expect. On the other hand, there has been some moderation in economic activity. We're starting to see the labor market just weaken a little bit in the US. And the Fed doesn't want to keep interest rates too high for too long as well. And I think that's what Chairman Powell has been saying recently, that he expects the Fed to continue on its path of 75 basis points of cuts this year. We currently expect 75 basis points of cuts this year. Our US economics team projects that by the end of the year. And there is some risk to that, especially if the inflation picture doesn't moderate over the course of the next few months, and which is why we have other houses probably projecting less interest rate cuts out of the Fed this year.
So still 75 basis point, and what is the timeline? Do you think it will start by the second half of 2024 or maybe in the last quarter of 2024?
Yeah, we expect the rate cuts to begin towards the second half of 2024. The first cut should be somewhere around June or July in our projections. Of course, the calculus to that changes once the inflation data becomes clear for the Fed, right? I think if the sequential inflation rates in the US are higher, then the Fed might have to rethink its path over the course of the next few months. However, if inflation comes in line with our projections, then we expect that the first rate cut should happen by June or July, and we should have 3 more by the end of the year. Which would mean the start of a monetary policy easing cycle globally.
Do you think the Fed's target of inflation in 2% is still relevant?
Yeah, absolutely. I think a Fed's inflation target is useful in anchoring inflation expectations. I think there has been a debate recently about whether the inflation target should be calculated from pre-pandemic, right? What we saw was a period of very high inflation. So inflation was more than 2% for a while, which would mean that to get back to our 2%, we might have to keep monetary policy tighter for longer. But having a 2% clear goal is useful for market participants to form inflation expectations. So 2% is a relevant target, and at the growth rate of the US economy grows between 2 and 3% per year. So the inflation target seems to be fairly aligned with that growth number.
Based on US economic growth right now, do you think 2% will be reached this year?
On the inflation side, yes. we think that 2% inflation will likely not be reached towards the end of the year. We think that on a sequential basis, we will be reaching 2% probably towards the end of this year, early part of next year. But for the year as a whole, inflation is still likely to come in slightly higher than the 2% mark. Right now, inflation running slightly more than 3% in the US. So there is some core inflation pressure that we're seeing. One other important swing factor is going to be energy prices, right? If oil prices remain at the current level of about 86, that still slightly increases inflation a little bit. So that is going to be a factor. If they fall back towards the $80 mark, that's supportive for inflation globally.
All right. How do you see global investor psychology right now during the volatility of cut rate expectations?
Yeah, there has been some volatility over the past week or so. In particular, we've seen several exchange rates in Asia Pacific decline over the past week. There has been some capital flow volatility. I think some of the risk around the central bank is there's some caution going into the investors' calculations at the moment. However, broader financial markets still remain fairly stable. We don't really see massive corrections in equity markets. Fixed income spreads remain fairly tight. So financial conditions are still positive at the moment. And I think barring any surprises out of large surprises out of economic performance or the monetary policy path in the US or in large economies elsewhere, Europe, China, we think that investor sentiment should remain broadly stable throughout the rest of the year, even if it does not improve very sharply.
Do you see it affects emerging markets currency like Rupiah?
Yes, absolutely. I think it has been playing a very influential role in the path of the emerging market currencies, Indonesian Rupiah included. I think we saw some volatility in the IDR over the past few days on speculation regarding the interest rate path, etc. So we continue to expect that is going to be a factor. I think Bank Indonesia is very aware of this, and they have been actively attracting portfolio inflows to offset that, and the interest rate difference between Indonesia and the US is positive, which is an attractive factor for investors as well.
Do you think the capital outflow from emerging market like Indonesia will continue further?
It depends. I think it depends on the big question that we talked about recently, which is the Fed and the number of cuts and the pace of easing. I think that is going to be a key determinant for investors who are thinking about their capital allocation, whether they want to hold US dollars or emerging market currencies. So I think if US inflation is high on the high side, surprises on the high side, and we expect less cuts from the Fed, that could be a risk for capital flows. We could see further weakness in emerging market currencies. On the other hand, if we start to see inflation in the US come down sharper than projections, and it becomes clear that the Fed might have to cut faster, and then we could see, on the contrary, emerging market currencies gain.
All right, in the domestic market, our expectation, the expansion will be significant after the election, but we haven't seen it coming. Do you think the interest rate is become the main factor right now?
I think the Indonesian economic story depends on a number of factors at the moment. Of course, the consumer sector, and I talked about the post-pandemic reopening, those are some key things that are playing into the picture. I think the investment side is also very important. We're starting to see private investment pick up a little bit, but overall, the investment story remains fairly moderate at the moment. So interest rates are playing a role, but I think there is a more wider story that's playing out in Indonesia at the moment. And we expect that, going forward, we expect that there is going to be some improvement in the infrastructure investment side and the private investment side as well, which should help to push up the growth slightly towards the end of this year, going into 2025.
On the other hand, we heard many bank centrals in the world trying to find a way to cut their rate before the Fed. Do you see any rooms for them to do it?
Yeah, there is room for central bank easing in Asia Pacific right now. In Asia, we continue to see inflation lower than what it is in the US and Europe, and inflation has been declining for a while. There are some risks to the inflation picture as well. Food prices, I think, is key. Food is a very important part of the inflation basket in Asia Pacific. So central banks are very keenly watching whether agricultural prices are going to come down as anticipated, or whether there is risk that we could see a pickup driven by especially El Nino effects this year, which could be a factor. In that case, there will be less room for central banks to cut. But if inflation continues on its current trajectory, then I think there is room for central banks to begin easing ahead of the Fed later this year.
How about our central bank, Bank Indonesia? Do you think we still have a room to ease earlier than the Fed, considering our volatility and currency?
Yeah, I think Bank Indonesia remains very alert about the exchange rate movements. So we do not expect that Bank Indonesia will cut earlier than the Fed, to avoid triggering capital outflows and exchange rate weakness. Inflation remains very much under control in Indonesia at the moment, around the 3% mark, which gives some comfort for the central bank that they can begin easing when the time comes. But we expect that given the risks to exchange rate volatility, the central bank is likely not to cut before the Fed moves later this year.
All right, and we know recently we have issues due to the elections result. And do you see the global investor are looking to our political issues right now?
Yeah, I think investors have been keenly interested in Indonesia as an investment destination for several years now, and I think this year that has not changed. Investors continue to be very optimistic about the growth prospects of the economy and what it can offer them in terms of returns. Indonesia's 5% growth target, for example, would be faster than the global average of about 3%. So those are some of the factors that go into the calculation. There is a degree of policy continuity in Indonesia as well, which makes the investment environment favorable for investors from that perspective as well. So there is definitely interest from investors on that front.
And also, Vishrut, we have talked about S&P projection of Indonesia GDP for this year and until the next 4 or 5 years. But as we saw, our elected president candidate was quite optimistic that our growth will reach 7 or 8% for the next 5 years. Do you think it's realistic?
So there's a number of factors that would determine the growth trajectory of Indonesia. I think a growth projection of 7 or 8% would require several wheels or engines to start kicking off at once. Investment, foreign direct investment, exports, technology, the financial sector, all of those kicking off at once. It is, I think, a tough task. And it is also something that requires time to get going. So I think even if we do move to a trajectory of higher growth, it's probably going to take 5 to 10 years before we can get there, as the economy kind of transitions to that higher growth stage as well. So it takes time, and it should hopefully we should be there in a few years' time where we look back and say that Indonesia is a 7% growth economy.
Okay, thank you, Vishrut Rana, Economist, Asia Pacific S&P Global Ratings, for being with us today.